Hello everybody, how is everyone doing today? I hope you're doing well wherever you're at. Today we're really diving into the numbers at a macro level across the United States, seeing how it's impacting your business locally and how we could thrive during this shifting market. All right, so the first thing we're going to be looking at is our home sales annually. All right, these are the units that we've sold across the United States. Last year, 2022, we're looking at right about 5 million homes sold, which dropped quite a bit from the previous few years where we're at 5.3, 5.6, 6.1, where we really saw a crazy market, right? And last year, towards the end of the year, we had a major pullback. We ended the year right about 5 million. The interesting thing to do is looking back over 2002 to 2006. During that time, we had 32.2 million homes sold, all right? And when that crash, when that shift happened, that first year after, we went right back to what? 5.0 million homes sold, right? Kind of where we finished last year after having a pretty good sustainable market. Then the year after that, and we look at 2008, we dropped all the way down to 4.1 million homes sold and stayed in the 4.1 to 4.5 range till about 2012. Pretty extended period of quite a few less homes sold throughout the United States. So what can we expect for us going forward? Well, every market's different. No one could predict the future. But taking our past data and seeing how other shifts have impacted us through home sales, we could expect about a 30% drop in home sales. So we're looking around that 4.1 to 4.4 range of homes sold. And if all indications have showed us so far this year, especially locally, where we've been about 40 to 50% less homes sold each month, we could kind of expect around that 30% range of less homes sold, which is less transactions for you and me, all right? So let's get on to the next one. Our annual home prices, right? So I love this. We talk about real estate as always a good investment. It's one of my favorite slides talking to buyers is should I buy now? Should I buy now? When's the best time to buy investment property or property? Yesterday. It's like planting a tree, right? The sooner you buy it, the sooner you could build equity in the home. So even if you bought in 2006, right before the big crash, if you held onto that property through that time, you did quite well with it over these last few years. We see the trend line at 4%. On average, 4% is what we want to see a home appreciate year over year. So you see that in 2004, 2005, 2006, we're well above the 4% range. Then we have the big collapse, right? We dropped way down and we've slowly built back up. And now we are past that 4% average rate of return or average appreciation over long term. And we've actually been over about 12% over the line in 2022. So we've seen that continue to climb year over year, and we're projected to be well over that still into 2023. So you can see the home's still appreciating over time, and it's always still a good investment. This is a great slide I recommend to use when you're on your listing or your buyer's presentations, letting buyers know that over time, real estate is always going to be a good investment. All right, sticking with home prices, now we're going to be jumping into the annual appreciation. You could see over the time period of 1990 to 2000, we had almost the exact 4% we'd want to see annual appreciation year over year with the houses. Then in 2001 to 2005, we jumped up to 8.885%. We had a lot of annual appreciation happening. And then right until about 2006, right, towards the end of 2006, where we really saw the market come to a stop and really start to come the other direction. Then from 2006 to 2011, we saw prices decrease on an average of negative 4.4%, right? In 2009 being the worst at 12.9%, with 2010 being kind of flat, and then again 2011 coming back down. So there was really that 5-year period of some pretty tough times with prices coming down. Then from 2012 to 2019, we continued to climb from the 6 to the 11, back to the 5, averaging out about 6.37. Then we see the craziness of after COVID and money coming in, where we jumped to 12.5% annual appreciation year over year coming up, which is really, really high, right? And now for the first time in a long time, we're actually projecting for us to come back down about 1%, according to NAR, about 1% that we're going to be coming down the other direction. So prices aren't really falling, but yet they're not climbing anymore like the rate that they were. They're probably going to be maintaining pretty average over the next year. So we'll have to keep a sharp eye on that to see what happens. All right, now we're going to look at the total market volume. And what I really want you to pay attention to here is how many agents were in the business, how much volume was available for agents to make money, right? Because people tend to follow the money. They see real estate agents making a ton of money, more agents get into the business, right? And then they're typically a little bit behind the market. So as a bunch of agents come in, the opportunity to make money comes down, and then a bunch of agents get out. More opportunity comes to make money, the more agents to get in. And this kind of shows that here. So if we look back in 1999, when our dollars and volumes were in trillions, we were just under $1 trillion in volume for money to be made for agents. We had about 761,000 agents a part of NAR. And as that climbed through 2005, when we almost had $2 trillion in volume amount of money, we had 1.3 million agents in real estate. Well, then the market crashes, the volume goes down, we cruise back down to about 1 trillion in volume, then under $1 trillion in volume. We lost about 300,000 agents during that time. Less money to be made, agents had to go back to their regular jobs. They were struggling to make it in the real estate market. Well, as we continued to climb in volume year over year over year, more and more agents got into the game. And you can see in 2021, we had almost 3 trillion in volume. There's a lot of money in real estate. Agents are able to make this money. And in last year, we had 1.6 million agents a part of NAR. But now we see that trend going the other direction, less money in real estate. So we'll expect those agents to follow. In fact, NAR expected anywhere between 300,000 to 400,000 agents will be out of real estate by this time next year. That's a significant amount of agents that are going to be getting out of the business because there won't be the same amount of volume opportunity for these agents to make money. Something important to pay attention to. All right, now let's check into inventory across the nation. And we always know inventory is our supply and demand in real estate. We call it an absorption rate locally. The more inventory we have, typically the less demand, right? The more demand we have, the less inventory. It's a great indicator to tell us what our supply and demand looks like. So if we look back in 2001 through 2005, our inventory is about 4.5 months across the nation, right? Kind of almost a little bit of a seller's market. We look for 5 to 6 months to be kind of at a balanced market. So a little bit of a seller's market, but healthy both ways. Wasn't incredibly difficult for buyers to get in. It wasn't all the way a seller's market, almost a balanced market during that time. Then we had the big collapse, right? We had the big collapse, and all of a sudden inventory starts to climb, and it climbs rapidly. Through 2006, 2007 to 2008, we almost had 10 months supply of inventory on the market. That's truly a buyer's market. That's where we saw those first-time buyer programs come in, a lot of concessions to really help people get their homes sold, and that helped drive prices down, right? Then we look back in 2012, inventory started to get to more of a sustained level. Through 2018, we were hovering between the 5 and the 4 range, those months of inventory. Then COVID craziness happens, and all of a sudden our inventory, everybody wants to move, really starts to sharply drop where we're truly in a seller's market from 3.1 months to 2.3 to 2.7 months supply. Now it's interesting to keep an eye on because we're not seeing a lot more inventory come into the market as sellers are hesitant to sell to go get into a different interest rate somewhere else. But that's really still showing us that we don't have a ton of inventory to really spike a big drop in prices. Now, if that inventory starts to climb, we could start looking at those prices coming down because there's more competition. But as we stand right now, there's not a ton of inventory yet to really see a drop in price over the next year. Mortgage rates. The bane of our existence right now. Right? Mortgage rates, we've all been talking about it. We know they've been going up, and the truth is they had to, right? We know one of the greatest threats to democracy is runaway inflation. And when our country had massive, massive inflation, we expected the Fed was going to have to jump in and do something to help stop that inflation from going rampant, right? How do they do that? They got to get people to stop spending money. They do that by raising rates. And we saw that last year with rates consistently being raised. Every single time they got met together, the Fed met together, they would come out with another rate hike, and we're still seeing that. In fact, just today they announced another 0.25% rate hike, even though the bank collapses and some of the concerns with what was going on in the financial world, they've still decided to raise the rates because they are so worried about inflation. And we can see that's dramatically impacted what we're doing in our business. Money was so cheap in the last few years, everyone was buying it. Affordability was still there, even though prices were high because our interest rates remained so low. Historically, though, we are still at a pretty good rate. If you look back since 1972, our historical average is almost 8% interest rate, right? If you look back from 1990 till now, our average rate has just been right about 6%. Right, and our rate has fluctuated. This was done towards the end of the year, so obviously our rates have gone higher since then, but our rate has been fluctuated right to where our historical average has been. In fact, we expect these rates to stay this way for quite some time. We may never ever see 3% interest rates again in our lifetime, right? Because as the economy is moving, we have to make sure our inflation's in check and other balances, right? The interest rate will probably stay high, and we'll have to learn to adjust and find different programs and different avenues to help our buyers get into homes. We'll see what that does with our sales prices over the next few months. But as of now, we could expect these rates to stay, and how we're going to adjust to the new norm as people get used to paying a higher interest rate than they were 2 or 3 years ago. Which brings us right into affordability. Of course, if interest rates start jumping up and our prices really haven't come down, we're really just not affordable as we used to be. The interesting thing to look at, if you look back at the long-term average, right, we have been actually quite affordable over the last few years, even though people have been saying, oh, the prices are so high, prices are so high. But if we look at the monthly payment because of such a low interest rate, we've been actually quite affordable. And that's been one of the reasons why so many houses have been moving and we've been selling so many homes, is affordability has been there. But if we look back now, we've kind of jumped way up to the other side. It's caused this market to stop because interest rates have jumped up so much over the last year. Things are no longer affordable. Those monthly payments are no longer realistic for most people. So our affordability is higher than it's been since 2005. And so this is where we'll have to get to, how is this going to affect our market? How much is it going to slow down? Who can afford these things? What kind of other programs or incentives can we do to get things more affordable for buyers to be able to move into the homes right now? And that's why you're seeing a lot of people just not really looking to sell or buy right this time, as they're waiting to kind of figure out what is going on, what is the new normal, and what are we going to do to move forward. All right, so that kind of affects overall globally of our markets and the key points we're looking at. But obviously we have to look at the economy and see how that's going to affect us as well. Because one of the things we're always looking at, is this going to head us into a recession? Is this going to keep us afloat? Really, we hit a recession last year. We had 2 consecutive quarters of GDP being in a negative. We bounced back up over that time, but where are we heading and what does that look like? Well, one of the key indicators we have to look at is our GDP, our gross domestic product, right? How much product is being made in the United States? And our goal here is to always be around 2 to 3%. We want to make sure our economy is moving in the right direction, right? And if we look back in 2009, we had the Great Recession. We had obviously a troubled economy during that time, and housing as being a big part of that is not moving. We saw back at the previous slides, we didn't have a lot of sales during that time. Prices came to an all-time low. We really had a kind of a tough time during that period. Well, in 2020, we kind of have to look at that as we had a pandemic. We had a very unique time in our history. The world shut down, so of course, but that's why you also see on the back end of that, we shot up past that the next year because we came off the pandemic and we dumped a ton of money into the economy. People were spending a ton of money. So those 2 years are kind of an influx, and we'll see how the effect is on that time will tell. As of right now, our economy is moving in a steady direction, kind of where they wanted to see it. So that's an indicator. As that drops back down and we might see more of a recession coming, we have to keep an eye on what that looks like when they stick out the number. All right, the next big indicator is unemployment, all right? Unemployment. How does our unemployment look? Anything under 4% across the nation is considered a good number. You want to have people that are working, that can be working, out there working. So our unemployment right now is looking pretty solid. Now, I know where there's a lot of talk about tech industries laying off thousands and thousands of people, and people are concerned with that. But we have to realize that's such a small pie of the overall workforce that it really isn't going to have much an effect in these numbers as of today. But we have to keep an sharp eye on what does the unemployment look like over the next few months to see that number start to steadily climb. We could see more of a recession coming, having a more long-term effect on our housing market. If the unemployment stays below that 4% and it's kind of at that healthy number, we might be able to see a quicker recovery. So we're going to keep an eye on unemployment to see what's happening over the next few months. All right, now we're going to be looking at personal savings rates, and this one has me a little bit concerned. So we're looking at what does it look like at our personal savings rate, right? What the individual's personal savings percentage that they have. And unfortunately, in 2022, as we were looking at this, it's one of the historic lows. People do not have money in savings. And so if something was to happen, like a loss of job or something tragic was going to happen, they would need help support quicker. And that's concerning. A, they're less likely to have money for buying a home, and B, for any other catastrophic events that may happen, they may rely more on the government, may have more effect on our economy as a whole. Obviously, in 2019, we had a huge spike in personal savings. The government was giving away money. There was all sorts of craziness going on. So those numbers are always kind of, we're going to kind of take those with a grain of salt. But we're looking back historically and seeing between 10% to 13% to 9.5%. In 2005, right before the Great Crash, we had only 2.9%. So seeing the personal savings is a little bit scary. We have to keep an eye on what are people doing with their money, as inflation has gone up so much and the price of eggs and milk and everything being so expensive, people are having less and less money and they're taking out of savings to get through. So we have to keep an eye on what does that look like for most people. Are they going to get into trouble? Is there going to be more government intervention or things that are going to help? Time will tell, but it's an indicator that it looks like there's going to be more scary times ahead over the next few months instead of a quick recovery. All right, inflation. We talked about a little bit of inflation before, but here's our graph showing our inflation and why our interest rates have gone up so much. When COVID happened and we dumped a bunch of money, obviously that's going to cause inflation. That's a big concern. Our inflation drops, inflation around 2%, that's the goal. You want to see inflation being around 2%. When we see inflation get up to 5, 6, 7, even 8 or 9%, that's when things get scary and we have to take drastic action, because we know that hyperinflation is a threat to democracy and we have to keep the democracy together. We can't let everything fall apart. So the Fed started raising rates rapidly, very rapidly, which caused the market to come to a screeching halt, right? They do project by 2024 that we could see the inflation getting under control. But that's a projection, right? And we have to keep a sharp eye on inflation. If we see inflation jump again over the next few months, you will expect interest rates to continue going. Now, here's the caveat. There's some banks doing some bad investments, and now in the last few weeks they've gone under because the inflation and the interest rate has gone up so much to fight inflation. Unfortunately, that's affected some of the treasury yields where these banks have been investing in. And unfortunately, they're taking losses, and now they're having to go under. So this is one of those first steps that we have to keep a sharp eye on to see what happens. Best case scenario, we see inflation continue to drop. We may be able to get steady for a few 6, 7 months to a year of higher interest rates, but we stay steady and we get things back under control. If inflation keeps going up, all bets are off, and we'll see what happens then. And this is just an interesting for your statistics here. It's just showing where inflation has mainly gone up over the United States and what it's cost the most money over time and what's gone up. And I always find it funny is it's 97% cheaper to buy a big TV than it was back in 2000. But looking at where it's really affecting our inflation, at the top is hospital services, college tuition, college textbooks, medical care. All those things have really gone raised over time. Housing's gone up almost 87.1%. And a lot of other things have actually even come down a little bit, which is interesting, like clothing and other avenues. So we'll keep an eye on inflation and see what happens over the next few months. All right, so we talked about how the volume overall of sales affects the amount of agents that are in the real estate business. Right now we're going to be looking at the sides per agent, because this has a big effect also on how many agents are going to be in the business and how much money you make. So let's go back and look at 2000, from 2000 to 2007, right? The average size per agent dropped from 13.5 to 7.5. We know, as we're looking back at those graphs, that from 2000 to 2007, we had some of the best years of real estate. A ton of sales was coming out, so more and more people were wanting to jump into the game to get some of the action, right? Then from 2008 to 2012, when our volume was really low, we went from 6.9 to 9.3 sales per agent. And then from 2013 all the way to 2022, right, we went from 9.8 back down to 6.3. So what can we expect over the next few months? And this is what we talk about, taking market share during a time of a shift. As many agents get out of the business, it'll be less competition for agents to go out and find business, right? For the ones that really go out there and try to find business during this tough time, they'll be able to take that market share. And if they're a good agent, hopefully they'll never have to give it back. So we'll see what happens over the next couple of years, but we could see that the average size per agent we could expect over the next few years to actually go up as more and more agents get out of the business. So now let's look at volume per agent, because really volume, we get paid on volume, right? We sell a home. Yes, units are important, but we get paid on a percentage of whatever the volume is. And you could see over the last few years, we've had the highest volume ever because we've had the highest prices ever. So over this year, we're looking at about a 3.2 million in 2022 paid on volume per agent, which if you do the percentages, depends on splits and all that fun stuff, but you're looking between $40,000 and $70,000 for an agent to be able to live life off of, which is a better amount than back in 2008 and 2009 when it was closer to that 1.7. Now it's always going to depend on what the prices look like, and if prices come down, obviously the volume comes down. If prices hold, we could expect the volume to be similar. Here's some interesting information. Just over the last year, we're looking at listings with the price drop because this is indicating what's going on in the market. We know back in May is when we really started to see those interest rates go up, and what did we start to see? Price decreases, price decreases, price decreases. And crazy to me, in October, we almost saw 60% of every listing have a price drop. And a lot of that has to do with we're slow, we're quick to react, we're slow to be proactive. So we knew the shift was coming, we could feel it, we could see the interest rates going up, but yet we were still pricing our homes of 7 months ago when we'd have 19 offers and everything was great. We were slow to react, to be aggressive with our pricing to make sure we priced it right as we saw the slowdown coming. So many agents had to be reactive instead of proactive to what the market was telling them. So we'll continue to see that over time as more and more price decreases, as more and more things are sitting on the market. All right, then we're looking at distressed sales. How those REOs going to be looking, those short sales? Well, it's tough to say because banking financing has been really improved since 2007 and really making sure people are qualified. A lot less funny loans have been happening, right? And we know the economy is still doing okay and people still have their homes. So as long as they maintain their jobs, they'll be able to maintain that payment. As long as they maintain that payment, they should be okay in their homes. And also with the way the prices jumped 12% over the last couple of years, most people that will lose their jobs hopefully will have equity in the property and be able to get out before they have to go into distressed sale, right? Still, there will be distressed sales across the nation. We do expect that to come up. But currently, for the last few years, we have to take COVID in effect. The banks weren't foreclosing on people. So it's always, let's see how this looks as time tells. But still, less than 1% of every sale was with a distressed property. As time moves forward and we'll see what happens with the economy, if more hyperinflation or people start losing their jobs, we could see a lot more uptake in that. A lot of people have predicted that. As of right now, we're yet to see it, so we have to keep an eye on to see what's going to happen over the next few months with distressed properties. Student loan debt. How does student loan debt affect us in real estate? What do we care what young people go get in debt on? That doesn't concern us. Well, here's why it does, all right? The first-time home buyer. Historically, the first-time home buyer has always been in the mid-20s. And now, because of the student loans and kids coming out of college, landing great jobs, but spending more than a mortgage on their debt for their schooling, they simply cannot afford to be a home buyer. And that is pushing back the age of the first-time home buyer to almost the mid-30s, which is incredible. You look at $1.6 trillion in student loan debt, with $2.9 trillion being all other debt. Right? So all these young people are typically coming in, buying homes, fortunately aren't able to do it till later on in life, which is affecting our sales numbers, right? So what's the solution? I don't know. Don't go to college. I don't know. That's up to you. You have to figure out what's right for you in your path, but it's something to pay attention to because at the end of the day, the student loans are really affecting the first-time home buyers to be able to generate wealth over time. All right, so we're wrapping it up this way. Unfortunately, I didn't realize my microphone had died on the last slide until editing, so I'm redoing this section right here, just wrapping it all up. What does this all mean? Well, really, we don't know. At the end of the day, there's a lot of internet gurus out there. Everyone's professional. There's a lot of everyone repeating the same thing as they hear. Really, we need to get the information, formulate our own opinion, and make sure we do our best to show the information to the clients and let them decide, right? Because We just don't know. There's also a lot of economic risks, things that could happen that could totally change every projection and everything that we expect to happen, right? Further escalation with the Ukrainian war. We get dragged into some war, who knows what will happen? We can't predict anything once that happens. Life would change, right? A resurgence of inflation. If inflation drops back up 7, 8, 9% again, keep a number on those numbers. When they come out, keep an eye on those numbers, because if those come out, that could change everything, right? Debt ceiling brinkmanship. So Republican, Democrats always fighting about whoever's in control, raising the debt ceiling, kick the can down the road, if the government shuts down, that could have an economic risk as well, right? Political tension with China, same thing with the Ukrainian war. If we get drawn into an escalation with China over Taiwan or any other thing, all bets are off of that side. And then any environmental concern, right? National disaster, earthquakes, fires, anything that hits, especially us locally, fires or an earthquake, obviously that could change everything and then make nothing that we say matters. But what I think is going to happen, just looking at the numbers and who I've listened to and economists I've listened to, I think it's going to be a slow year. I think it's going to be a slow year and a half. Interest rates are going to remain high. And we're just going to sell less homes. I don't think we're having a collapse. I think it's just going to slow down and settle until people get used to the new norm of interest rates being at 6, 7, maybe even 8%, and finding ways through assuming loans or some other ways to get into homes. I think we're just going to be stale. And we'll see what happens. Eventually, things will turn around. Things will be good again. But for now, we got to get to work. We got to make sure we're the economists of choice with our clients and our customers. They come to us for the information, and we need to know our information so we could give our clients, be the true fiduciary, the best information for them to make the best decision that's right for their family. So I hope you guys enjoy this. I hope this gives you some information, some credibility with your clients, and give them good information about what it's looking like and what our market's going to do. And remember, nobody could predict it for sure. All right, have a good one.